$500 million. That is the number I want you to fix in your mind before I tell you anything else, because that number is the entire story compressed into a single line on a balance sheet. Every 24 hours, the regime in Tehran is now losing roughly $500 million in oil revenue. Not earnings, not projections, cash. Cash that used to arrive in specific accounts controlled by specific people deployed for specific purposes, and that cash is no longer arriving. To put that number in context, $500 million per day is roughly $180 billion per year. The annual military budget of a mid-sized European country. The total foreign exchange reserves of many emerging economies. Lost, not gradually, daily. To understand how a single missile strike on a single freighter fits into something this large, you have to first understand what Iranian oil revenue actually is and where it goes. The Islamic Republic does not run its oil sector the way ordinary states run their oil sectors. The petroleum revenue does not flow primarily through a national treasury, get audited by a parliament, get distributed across a national budget, and emerge as schools and hospitals and roads. A portion does. The majority does not. The majority of the revenue is routed through opaque networks controlled by the Revolutionary Guard Corps, the parallel armed wing of the regime that effectively functions as a state within the state. These officers and the political class allied with them are the actual beneficiaries of every barrel that leaves an Iranian port. They are also the patrons of the militias the regime uses to project power across the region. The proxies in Lebanon, the proxies in Yemen, the networks in Iraq, the networks in Syria. Cut the revenue and you cut the patronage. Cut the patronage, and the proxies begin asking uncomfortable questions about whether they are still going to be paid. The Revolutionary Guard owns or controls a vast portfolio of business interests inside Iran. Construction conglomerates, telecommunications companies, engineering firms, smuggling networks, real estate holdings. The estimates vary, but credible analysts have placed the Guard's footprint at somewhere between a third and a half of the entire Iranian economy. That portfolio runs on oil revenue. When the oil revenue drops, the portfolio bleeds. When the portfolio bleeds, the officers who depend on it for their personal incomes start making decisions that the senior leadership cannot fully control. This is what the United States naval blockade has been engineered to do, and the disabled freighter drifting in the Gulf of Oman this morning is not an isolated incident. It is the visible surface of an economic operation that has been running for weeks, with each day compounding the pressure on the regime's internal cash flow. The blockade now reports 5 vessels disabled and 116 turned back. The disabled 5 are demonstrations. The turned back 116 are the actual squeeze. Every ship that arrives at the Strait of Hormuz looks at the American observation grid overhead, calculates the probability of getting through, and decides to abort. Is a ship that takes cargo somewhere else. That cargo represents fees, taxes, port charges, refinery feedstock, downstream contracts, and ultimately revenue for the regime. And every ship that takes its cargo elsewhere is a small piece of that $500 million daily figure made real. Now, the people who are paying this bill are not the Iranian people in any meaningful sense. The Iranian people are paying a separate bill. They are paying inflation, currency collapse, fuel shortages, and an erosion of their savings. Those are downstream effects of the regime's choices, not of the blockade itself. The blockade is targeting the specific cash flow that fuels the regime's external operations. That is why this strategy is fundamentally different from broader sanctions regimes that have been tried in the past. Broad sanctions punish the population and rally the elite. Targeted maritime interdiction punishes the elite and leaves the population in a position to ask why their leaders are bleeding the country for a war they did not vote for. This is the lesson the Treasury Department and the Pentagon learned over 20 years of trying various sanctions architectures. The lesson is that economic warfare works when it isolates the regime from its own resources, not when it isolates an entire population from the world economy. The current blockade is the operationalization of that lesson. To see how this works in practice, you have to look at where Iranian oil was going and who was buying it. The largest buyers have historically been Chinese refineries, a category of buyers known in the trade as teapots, smaller independent operators willing to take sanctioned crude at a discount. These refineries clustered along China's eastern coast, particularly in Shandong province, became the primary downstream outlet for Iranian crude after the major Chinese state-owned majors pulled back to avoid secondary sanctions. The teapots operate with thin margins and high tolerance for political risk, which made them perfect customers for sanctioned barrels at depressed prices. There were also routes that ran through Pakistan, through Iraq, through Syria, through Venezuelan intermediaries, and through a web of shell companies operating out of free zones in the Gulf. The blockade does not need to interdict every barrel from every route. It needs to introduce enough uncertainty that the insurers, the bankers, the freight forwarders, and the receiving refineries decide the risk premium is too high. That is what is happening right now. The Chinese teapots are slowing their intake. The Pakistani transit routes are being scrutinized. The shell companies are being identified and exposed. Each step compounds. Each compounded step accelerates the decline of the revenue stream, and the regime cannot replace it. Iranian oil is not like Saudi oil or American oil or Russian oil. It is heavier, it is more sulfurous, it requires specific refining capacity, and it can only be sold to a limited set of buyers willing to handle the political risk of buying it. There is no quick pivot. There is no alternative market. There is only the same set of buyers under increasing pressure to stop showing up at Iranian ports. The refinery configurations that handle Iranian crude were specifically built over years of investment. They cannot be reconfigured overnight to take a different feedstock, which means the regime cannot simply find new customers if the existing customers walk away. The supply chain on the buyer side is as locked in as the supply chain on the seller side. The freighter that was struck this morning was carrying out exactly the kind of test run the regime has been running for weeks. Send a smaller vessel under a flag of convenience, route it through a sympathetic transit port, see whether the United States is paying attention. The freighter was Gambia flagged. It had departed Karachi. It was making for an Iranian port. Every one of those data points is a deliberate choice intended to muddy the legal and political picture. Gambia is a small West African nation with a history of providing flags of convenience to vessels that prefer not to fly the flag of their actual ownership. Karachi is a Pakistani port that has been used repeatedly as a staging point for vessels making Iranian runs. The combination was designed to give the regime plausible deniability and to test whether the American operators would distinguish between a sanctioned tanker and a generic commercial freighter. They did not distinguish. The vessel was identified, classified, warned, and disabled. The pattern of the failed test will discourage repeat attempts. The deterrent is the real product here. The disabled ship is a visual artifact. The deterrent is what travels through the global maritime insurance market, through the shipping intelligence community, through the chartering desks of every commodity trader in the days that follow. The cost of insuring a vessel for an Iranian port call rises. The cost of chartering a vessel willing to make the trip rises. The pool of crews willing to sign for the voyage shrinks. Every one of those secondary effects feeds into the $500 million daily revenue gap. The Lloyd's of London market, the international protection and indemnity clubs, the marine cargo insurers, all of them adjust their underwriting models based on incidents like this. The adjustment is not theoretical. It shows up in the price of every policy issued for the next quarter. And those price increases get passed back to the cargo owner, who then has to decide whether the deal still makes sense at the new total cost. The reinsurance market behind those primary insurers also adjusts. Reinsurance is the layer of capital that backs the policies the underwriters issue. The reinsurance treaties that cover the Gulf region get renewed annually. After every incident of this kind, the renewal terms tighten, the exclusions widen, the deductibles rise, the premiums climb, and those changes cascade through every voyage that touches the region, including legitimate voyages by carriers that have nothing to do with Iran. The unintended consequence is that the entire Gulf shipping economy economy becomes more expensive for every participant. Carriers that maintain a clear distance from sanctioned Iranian trade still pay higher premiums because they are operating in the same insured geography. That cost increase is itself a form of pressure on the regional shipping community to push back against the actors who are creating the problem. The pressure is indirect, but it accumulates. Now I want to address the Iranian strike on the American airbase in Kuwait because it is directly relevant to this economic story. Iranian regular forces launched a Fatah-class short-range ballistic missile at Ali al-Salem Air Base, home of an important American expeditionary wing and a critical logistics node. The missile was intercepted by Kuwaiti air defenses. Debris injured several Americans and destroyed at least one Reaper drone on the ground. The strategic logic of this attack from Tehran's side is straightforward. The blockade is enforced by aircraft, helicopters, and drones operating off of regional bases. If you cannot break the blockade at sea, you can try to interrupt the logistics that sustains the blockade on land. It did not work. The missile was intercepted, the base remained operational. But the attempt itself reveals the regime's calculus. They have moved from indirect attacks through proxies to direct attacks using their own forces against American personnel. That is an escalation. And it is the escalation of an actor running out of room to maneuver economically. The desperation has a name and a face. A senior advisor to the new claimed supreme leader has been publicly accusing the United States of betraying diplomacy. The accusation does not match the facts. The United States has been at the negotiating table. Reports from the last 24 hours indicate Iran has now committed in principle to neither developing nor acquiring nuclear weapons. That is a significant concession. It does not arrive at a negotiating table because of goodwill. It arrives because the regime is watching its revenue collapse in real time and has to choose between concessions on the negotiating side or further damage on the enforcement side. Every day without a deal is another $500 million lost. Every week is $3.5 billion. Every month is $15 billion. The compounding nature of the loss is what is driving the diplomatic timeline. The regime cannot wait the United States out. The United States is not the one being financially exhausted. There is also a longer-term consequence here that nobody in the immediate news cycle is talking about. The blockade is teaching every other regime in the region a lesson about what happens when American maritime power is deployed with conviction. For 2 decades, there has been a quiet assumption that the United States would not use the full weight of its naval forces to enforce a regime change adjacent objective. That assumption has now been broken. The Gulf states are watching. The Indian government is watching. Beijing is watching. The signal being sent is that maritime trade can be reorganized by force when Washington decides the cost is worth bearing. That signal is going to change behavior in capitals across the world, well beyond this particular conflict. It is going to change the way states think about choke points, about flag of convenience strategies, about shadow fleets, about every workaround that has been built up over years to manage life under American sanctions. The workarounds have just been demonstrated to have a ceiling. The ceiling is whatever the United States Navy decides it is. There is one more strategic point I want to leave you with before we close. The regime in Tehran is not actually negotiating to end the war. The regime is negotiating the terms of its own survival. Every statement coming out of Tehran framed as a diplomatic position is, when you read it carefully, a sovereignty claim. The mullahs want to retain the ability to manage transit through the Strait of Hormuz. They want to retain the ability to collect tolls. They want to retain the position of regional gatekeeper. They want to come out of this conflict with more leverage than they had when it started so that they can rebuild the infrastructure that has been damaged, replace the assets they have lost, and emerge as a peer competitor in a way they were not before. The blockade exists specifically to make that strategic objective economically impossible. As long as Iran cannot freely transit oil through its own ports, as long as the revenue stream is choked, as long as the patronage networks are starved, the regime cannot pursue any of those longer-term objectives. It can only manage decline. And manage decline in the cold economics of regime survival eventually forces a decision. Either the regime accepts the terms being offered, which means accepting a reduced role and a constrained future, or it escalates in a way that gives the United States justification to escalate in return. Before I close, I want to add one more layer to this economic picture that does not show up in the headlines, but is fundamental to how the regime actually operates. The Iranian financial system has spent 2 decades building workarounds to sanctions: Hawala networks, gold smuggling routes, cryptocurrency intermediaries, front companies registered in jurisdictions with weak compliance regimes, cash couriers moving physical currency across borders, bartering arrangements, trade-based money laundering. Every one of these workarounds was designed to allow the regime to continue receiving payment for its exports even when the formal banking system was closed off. The blockade is now disrupting these workarounds, not by attacking them directly, but by reducing the volume of trade that they were designed to facilitate. When the ships are not arriving, the gold smugglers have less to smuggle. The Hawala dealers have fewer transfers to manage. The cryptocurrency intermediaries have fewer settlements to process. The entire shadow financial architecture that the regime built to survive sanctions is being starved of the underlying commerce it was supposed to enable. There is also a secondary effect that nobody on the regime's side seems to be fully accounting for. When patronage networks lose their funding, the personnel inside those networks start making their own arrangements. The mid-level operators of the Iranian shadow economy, the people who actually run the front companies and the smuggling routes and the financial intermediaries, are now sitting on relationships, on information, on assets, and on operational knowledge that they will need to convert into personal survival as the system around them contracts. Some of them will defect. Some of them will start cooperating with foreign intelligence services in exchange for protection. Some of them will simply walk away from their assignments and disappear. Each of those personal decisions further degrades the regime's operational capability, and the regime cannot replace these people quickly because the skill set involved in running a sanctions evasion network is not something you can recruit out of the regular labor market. It requires trust, experience, and connections that take years to build. When you lose a node in that network, you do not just lose a person. You lose an entire operational capability that took years to develop. Watch the freighter drifting in the Gulf. Watch the missile intercepted over Kuwait. Watch the rhetoric from Tehran. The pattern is clear. The economic pressure is producing political behavior. The political behavior is producing military behavior. The military behavior is producing further economic pressure. That feedback loop only ends one of two ways, and the regime in Tehran knows it. The $500 million per day is not a statistic, it is a clock, and the clock has been running since the blockade began. Every tick of that clock is a barrel that did not move, a contract that did not close, a payment that did not arrive, and a patron that did not get paid. The arithmetic does not lie. The arithmetic does not negotiate. The arithmetic does not blink. And the arithmetic is the actual instrument of this campaign, more powerful than any missile that has been fired in the last 6 weeks.